All right, welcome to the Everyday Investor podcast, everyone. Today I'm sitting in with Kelly Eckhold, Chief Economist from Westpac. How are you, Kelly?
Very good, thank you.
Fantastic. So thank you for joining me on this discussion today. We're going to be talking about all things interest rates, inflation, property market, debt to income ratios, all that sort of fun stuff. Let's start off by talking a little bit about your background, because you've been the chief economist with Westpac for a little bit under a year, I guess, or so. But before that, you were working with the International Monetary Fund for quite a long stint. And before that, the Reserve Bank of New Zealand. So that's obviously quite a shift coming from the policy side now to the, on the tools side. So what made you make that transition? And, just give us a little bit of insight as to what it's like doing the role of chief economist there.
I was working in the IMF's Money and Capital Markets Department, and I worked on central banking issues, so the same sorts of issues that are sort of dealt with here. But I did work on a very broad range of countries, ranging from the US and the UK down to kind of like small developing countries. For example, I spent a bit of time in Myanmar a while ago as well, kind of like helping them develop their monetary policy framework. I mean, it's different in the sense that the difference between working in a commercial bank compared to either the Reserve Bank or the fund is that it's much more public facing. There's a lot more stakeholders. When you work in a central bank, most of the time you're working basically behind the scenes, preparing the analysis that is communicated typically by somebody quite high up at the top of the organization. Whereas for here, I am essentially the economics mouthpiece of the bank. It's my job to explain to quite a broad range of customers what's going on and what they should take from it. Some people are really in deep in terms of the technical aspects of economics and understand a lot of that stuff, and others are just ordinary people who want to work out when they should get their mortgage and what's going on with the unemployment rate.
Welcome to the everyday investor, right? Like that's kind of the idea, is that we'll go as deep as we need to, but really ultimately it's kind of about, well, what's going to happen with markets? How does this affect my mortgage rate? How does this affect the value of all my investments, including my own home? And so, to use a Wizard of Oz reference, when you were working behind the green curtain, did you notice like a shift between how transparent they became? Specifically, the RBNZ is kind of what I'm curious about. Maybe not so much with the IMF, but it feels now like they're a lot more public facing than what they had been in the past. Is that true?
I think there has been over the last 20 or 30 years an increase in the opportunities that central banks have to kind of speak publicly with the broader public. When I first started at the Reserve Bank back in the early 90s, we had semi-annual monetary policy statements and then 4 monetary policy statements a year. Those were sort of like the main mechanisms through which the bank would talk to the broader business community. I actually did a lot of work in the financial markets at that time, and we used to speak to financial markets quite a lot, but that was probably a bit less transparent in that you were having conversations at a reasonably technical level to market specialists, but not necessarily to the broader public. Now, most central banks are having, perhaps sort of like 8 meetings a year where they're regularly communicating about what they see the economy is going to do, what the outlook is for interest rates in the economy. Even though there are these increased opportunities for communication, it doesn't necessarily make the job very easy. It's still a challenge to exactly know what's going to happen. And that's why I think we've seen, quite significant changes in central bank views come through about interest rates, inflation, the economy, the exchange rate over the last 4 or 5 years, and it can be quite difficult, I think, for them to necessarily have a consistent message over long periods of time.
And on that, like we had a surprise, I guess I wouldn't call it necessarily an announcement, but there was like an unscheduled webinar today. Paul Conway at the Reserve Bank of New Zealand, it literally just finished. So by the time this recording comes out, it'll be a few days old. But your initial impressions of what his tone was in terms of directions of interest rates, and what was the general gist of that meeting?
General gist, and it's probably helpful just to remind ourselves what they said in November last year when they last talked. to the economy and markets, they took a pretty hawkish tone, right? They even threatened the possibility that interest rates might need to rise again over the course of this year. But a lot of water has gone under the bridge through December and January. Globally, markets now anticipate that central bank policy rates have peaked and that they're going to be cut reasonably significantly. So this was like the first update that we got from the Reserve Bank about, how they took all of that. The outtake I would have from the discussion this morning was that they still retain a fairly cautious tone with respect to certainly cutting interest rates. They didn't really give any kind of like firm guidance on the path for interest rates going forward. They will do that in 2 or 3 weeks' time when the next monetary policy statement comes out. But in terms of their interpretation of the data that's emerged in the last couple of months, they generally took it to mean that there's at least as much inflation pressure out there that they thought there was before. And even though growth has come off reasonably significantly, they think that reflects as much the productive capacity of the economy as opposed to necessarily demand on its own right. For analysts like us, we would interpret that to mean that they still think they have a bit of work to do before they can sustainably be sure that inflation is going to go back to that 2% midpoint target rate that they sort of really need to have happen next year.
There's two sides to the coin, I guess, and one would be a little bit cynical, where the view would be that the modus operandi of the Reserve Bank or any central bank would be to deny, and then finally cut. But then on the other side, they're looking at data, and so they have this dashboard, and I think maybe it would pay for us to maybe understand a little bit more, especially for those of us that don't, like, we understand some of the terminology, but maybe we don't understand some of the nuances behind how these variables interact together, like starting with inflation. So as we start this conversation off here and we discuss the interest rate and inflation outlook for 2024, can you just explain to us just some of the nuances between the inflation data that we see?
Yeah, so in terms of the inflation data, it's probably some of the better data that we have available in New Zealand, which is a bit unfortunate because most countries actually have much better range of quite timely information on a lot more broader things than just inflation. We certainly get a quarterly CPI, which basically it usually comes out quite fast, only a few weeks after the end of the quarter. So that's a very timely outcome compared to most economic data we receive here. Then we're also now getting these monthly updates of certain bits of the CPI, which Stats New Zealand can measure more frequently. So things like airfares, food prices, rents, for example, imported prices, which they can basically more easily collect on an ongoing basis. And now they're releasing that information to us within a week or two after the end of the month concerned. So that's actually really helpful in understanding some of the more volatile bits and pieces that kind of like throw inflation down. Petrol prices is a really good example, right? I mean, petrol can be 20 or 30 cents higher in 6 weeks, depending on what's happened to the exchange rate and oil prices. So we're able to kind of like see all that now. I guess the bits that we struggle to get a better handle on are things like services prices. In the Reserve Bank's parlance, they call that core inflation or non-tradables inflation. But it's actually the bit of inflation that reflects the demand and supply in the economy in New Zealand specifically. And it's the bit that interest rates is usually trying to impact. And one of the tricks of this trade is that you move your interest rate now, but you're probably not going to impact those prices for perhaps a year and a half or a year. So that's why the forecasting game is so important.
This is interesting. So there's the non-tradables or the core inflation, and then there's the tradables or I guess the inflation which excludes food and energy and all the stuff that seems to be dictated by overseas stuff. And so when the Reserve Bank of New Zealand, for example, increases our official cash rate or decreases it to influence the inflation rate, there's a lag but it's really only targeting that non-tradables or that core bit. It's got nothing to do with the other stuff that's overseas related. Is that correct?
That's generally correct, because there's not much the Reserve Bank can do if petrol prices, for example, suddenly rise because the oil price rises, or
Yeah.
if the exchange rate falls and things like imported sort of goods prices start to rise suddenly. The Reserve Bank does care about those things because they care about inflation expectations. So even though they may not be able to do anything about that aspect of inflation, if it generally drives the level of inflation up too far for too long, they worry that the public then says, oh, well, the general level of inflation isn't 2 anymore, it's 5, 7.
Right.
And then you end up with wage growth that kind of like picks up. And that's the real concerning bit, because that's the bit that generally filters into the core inflation. Like when wages go up, then services prices go up. You go and get your hair cut. If the person cutting your hair is getting another 10%, then chances are that's going to be reflected in what you pay. Um, and that's the bit of the inflation process that the Reserve Bank is generally most focused on
Sure.
trying to influence.
What about the relationship then between the OCR interest rates and the exchange rate? Because and this is how complicated I guess things can start to get, right? Because as our OCR goes up, then if it goes up higher relative to what's happening in the US, for example, that appreciates the New Zealand dollar, which makes the price of imports relatively cheaper, right? Is that right?
That's right. That's right.
Yeah, so that actually reduces the inflation, because that's actually affecting the tradables part of the inflation index, right? So
Yep.
I guess, but that's kind of a different timing, and that's dependent on what's happening overseas. So it's really quite delicate, isn't it?
Yeah. So I mean, that's the kind of question of lags, right? So it's certainly the case that if New Zealand interest rates start rising relative to foreign rates, investors usually start buying New Zealand dollars because it's a relatively good deal. Exchange
Yeah,
rate goes up, and you'll start to see some of those import prices starting to adjust, maybe within 6 months or something like
right.
that, if it's sustained. As I said before, like the impact of the interest rates on the core inflation isn't probably going to hit the core inflation part of the CPI for another perhaps year after that. Certainly helpful for the Reserve Bank that, like, if tradables inflation declines in that way, and that's been sort of certainly one of the things that we've seen in the last 6 months here, is that a lot of those imported prices or tradables prices have fallen off quite rapidly, especially things like food prices have fallen quite noticeably because they were impacted to the upside early last year with the Cyclone Gabrielle,
Yeah,
and the other bad weather events. So you'll still notice that it's quite hard to buy an apple right now.
yeah,
And
for sure.
a kumara costs a lot of money, right? Because it just
Yeah,
takes a bit of time for all of that stuff to come back up online again.
yeah, yeah. Okay, but any changes that happen from a policy perspective? So when the OCR goes up or down, there could be a general lag of somewhere between 6 to say even 18 months for that to be fully felt within the economy, right?
Yeah, and sometimes longer.
And so
Yeah.
we're now kind of at that. It almost feels like we're at this zero gravity place, or this, I guess you call it an apogee or apex, where you're changing phases, maybe. But during that phase transition, it's really hard to know for sure if we're really going to get through to the other side and there's a change in trends. And this is true, I guess, for like some really long secular trends, but also just in terms of this cycle that we're in with interest rates. It's hard to see whether or not we're done with the inflation problem, or whether or not it needs a bit more treatment. So let's just talk maybe about the general views that you hold at Westpac around where things are going with inflation, firstly, for 2024.
We anticipate that inflation is going to fall off reasonably significantly, actually, over the course of the next few quarters. Part of that is just mathematics. Like a lot of the really big quarterly increases in inflation are progressively falling out of the calculation as we go through this year. Like back in 2021, for example, there were like some quite significant increases in inflation due to the COVID effects on things like supply chains. Construction costs, for example, are really strong for that reason. All of the supply chains were screwed up, so insurance and sort of freight costs were really high. And most of those normalized over the course of the last year, and we're increasingly seeing that reflected now in inflation as we went through the last couple of quarters and as we will go through the next few quarters as well. So we anticipate that inflation is going to fall from the current 4.7% level to somewhere pretty close to 3% by the end of this year. That's pretty good news.
Yeah.
Even at 4.7%, I think we got the lowest annual inflation read for a year and a half, no, two and a half years, sorry. So that gives you a sense of just how strange the last few years have been inflation-wise. Things are moving in the right direction. But the challenge, though, I think that we have is that it gets increasingly harder from here to get inflation to fall much further. And that's why, today Paul Conway was speaking quite a lot, the Reserve Bank was speaking quite a lot about the stickiness of core inflation pressures. So the question here is not, will inflation fall or not? It absolutely will. It's a question of how fast and how far. And those are the questions that really determine what they'll do with interest rates. Do they need to keep interest rates at this sort of level for all of this year, for example, which is what my current forecast is?
Okay.
Or is there going to be scope, maybe if we get through to the second half of the year, for some adjustment in interest rates, because that headline inflation will have fallen far enough and the core inflation will have fallen a bit as well, such that they have confidence that when we get into 2025, they'll be able to get to 2%.
Okay. Like you say, it gets increasingly difficult to flush out that remainder of core inflation that might persist. But what about that momentum? Because it's clearly moving in the right direction, right? Like that's really promising in an environment where we also have deflationary forces, specifically technology that are in play, and maybe that's a longer time frame, but it's also exponential, so it's hard to really figure that out. Is it possible that the momentum of this disinflation will continue and eventually we might get there a bit sooner? Like how hard is that to kind of project?
It's actually quite difficult, but it's actually quite a plausible kind of like idea. That's why we're watching the data pretty carefully over the next 6 months to see kind of like whether that's actually going to play out or not. One of the discouraging things about the last CPI is that non-tradables component of it, that actually came in higher than most analysts forecast. So that wasn't actually great news, because that is the thing that won't just, it's unlikely to suddenly collapse. It's going to drift lower over a period of time with a slower economy and with high interest rates. The real big gains we got in inflation, for example, in the last 3 months were driven by things like food prices and airfares. And, things like airfares, they don't fall significantly every quarter. What tends to happen is, what has happened in the last 3 months is that energy prices have gone down, competition has increased. You notice there's a lot more airlines, for example, flying into New Zealand now, and as a result, the prices have adjusted back to something a bit closer to what is normal. But once they get to those normal levels, they don't necessarily keep falling at that rate, and that's where it gets harder.
Right. If we have inflation falling quite significantly, but maybe interest rates only falling towards the tail end of this year and only by a minor amount, if that occurs and the market anticipates that's definitely what's going to happen, will we see a reduction in the mid to longer term fixed rates at a rate which is faster than the reduction in the floating in 1 year rate?
Absolutely. Yeah, I mean, that's what I fully anticipate. And in fact, even now, we've seen some of those longer term expectations for the future OCR already decline quite a bit since sort of October, November last year. And as a result, banks are generally offering lower, for example, 3, 4, and 5 year fixed rate mortgages.
Yeah.
But you'll notice that kind of 1 year rate has been quite sticky. And it's sticky because the OCR is not moving yet. If we get through to the middle of this year, and if the market is right that rate cuts are coming either in the second half of this year or even early next year, well, then those rates will start to fall as well.
That's basically a negative yield curve. I know we're talking about that in the context of retail mortgage rates, but is that kind of predicting that we're going to see quite a steep, fast, sharp reduction in the OCR at some stage?
The market pricing implies that, right? So if I look at where the market pricing is for the OCR over this year, it anticipates perhaps 100 basis points of OCR cuts this year. There are not very many analysts in the domestic market that have that view. And I would add that internationally, markets are generally much more optimistic than forecasters about just how quickly and how significantly interest rates are going to fall. They may be right, or there may be a coming to Jesus moment at some stage in the next sort of 6 months.
Right. Okay. I want to talk really quickly about migration, because we hear a lot about the quantitative part of migration, like the number of new arrivals, net migration, but we don't hear much about, well, I don't hear much about the qualitative aspects of that. Like, what kind of jobs are they seeking? Do you have any insights there around what the type of migration that we have today will do to our economic growth and therefore inflation and therefore interest rates?
Mm-hmm. So one thing, first thing I'll say is we've had historic rates of inward migration in the last 12 months. I mean, total population growth is running close to 2.5%. Migration has been the driver of that. We've had plenty of New Zealanders leaving, but they've been well and truly replaced by a lot of foreigners coming in. The people are coming from primarily Southeast Asian sort of like jurisdictions, India, Philippines. And the feature of like most of those jurisdictions is they're lower income countries compared to New Zealand. So for people living there, if they've got the opportunity to come and live and work in New Zealand, it's a great opportunity because, you know, they will basically have better income earning prospects. They've been attracted here because in the last few years, we've had a really tight labour market. The unemployment rate reached historic lows sort of earlier last year. As a result, businesses have been screaming out for labour, and that was the mechanism that the previous government was using to try to satisfy that, is basically allow more visas basically for people to come to work here. What's happened though is that because of COVID, all through that sort of COVID period, people were getting visas, but they couldn't come because the border was closed. Border opened last year, they're all coming. And the impact of that has been is that it's suddenly become a lot easier for businesses to source labour. Most of the surveys that we see of business tell the same story, which, 18 months ago, people were really having to pay up to get people to do work. Now they don't have to anymore. And we would anticipate that will be reflected in weaker wage growth as we go through the next year or so. A lot of teachers, nurses, for example, a lot of people working in construction and food service and sort of in the tourism sector. I don't know if you've been to Queenstown recently, but you'll see a lot of foreign accents around there now, even around sort of like Auckland as well. Those were areas where, people couldn't get workers for a while, and now they've got them. So the implication of that should be that some of these core inflation pressures should actually come off because wage growth shouldn't be as strong, and wage growth is an important determinant of things like services prices. If I run a restaurant or something like that, then it's easy to get staff. But, for the really highly skilled top end of town, it's not so necessarily so easy because the mix of people coming in there isn't necessarily being directed at those people. Also, globally, economies have generally labour markets have been quite strong. There's quite a lot of competition for the highest skilled workers globally right now.
Okay. So when it comes to housing, I know that there's a lot of things that can affect housing, immigration being one of them, but that might initially more impact demand for rentals versus home buyers, initially at least. But as it relates to credit growth, like how much activity of new lending the bank is doing, what are we seeing in terms of credit growth at the moment in New Zealand?
Credit growth for housing has been recovering, right? It's not at boom levels, but it's been recovering. So I think on an annual basis, it's sort of sitting around the 5% type level. The Reserve Bank just issued the December data yesterday, actually. And I described that it's a recovering but not sizzling kind of like lending market for households.
Yeah.
So, and most of the household lending that's going on is going to owner occupiers, first home buyers, basically like people that I think have been sitting around for a few years looking for an opportunity to buy a house, have been saving money for the deposit. And they were the ones that have been active in the market in the last 6 months and have actually seen that housing market find a bottom and start recovering. What we haven't yet seen is what investors are going to do in the housing market. The election, I think, saw that market stop to some extent as people tried to work out who the new government was going to be and what their policies were going to be. And the sense is that, at least for investors, they want to see if some of the election promises, in terms of reinstatement of mortgage interest deductibility, adjustment to the bright line capital gains tests, is really going to come into force. At which stage we would expect that we might see them to come back into the market and start investing. And that's the sort of thing that I think would probably see credit growth for housing lending increase further from current levels. Credit growth more generally in the economy, though, is not that strong because, like for business, the business sector has been struggling in the last year. Growth has basically gone backwards last year. And we do see that reflected in reduced investment spending and less credit growth as a result.
These things are all kind of cyclical, aren't they?
Yeah. When right at the core, the Reserve Bank has basically stopped doing its quantitative easing and is gradually having assets roll off its balance sheet. So that's kind of reducing the money supply at the real basic level. But in those broader metrics, they really primarily reflect the fact that the economy has been slowing now for a year and a half or so. And credit is cyclical because the economy is cyclical.
Is the dog wagging the tail or the tail wagging the dog, though, right?
Well, we have a lot of debates around that, basically, about exactly what's driving what. I mean, my sense is that credit probably responds to what businesses want to do in terms of sort of how confident they're feeling about the future,
Yeah.
as opposed to necessarily the other way around. I don't think we've got a credit crunch, for example, in play in New Zealand at the moment. I think credit is available. There just aren't very many willing, good quality borrowers right now.
Mm. And I guess price and availability of credit kind of go in tandem, right? And so that availability credit is tied into what the rules of the game are. And so flipping over to that, what we've seen in the last I guess couple of weeks is increasing talk in New Zealand around how the Reserve Bank of New Zealand is consulting around the implementation of DTIs, or debt to income ratios. And it's yet another example, I guess, of how the decentralized way that retail banks used to work, where they would facilitate the interest rate, they would decide how much equity or deposit you need to buy a home, and then they would decide how much debt you could afford based on your income. That is now moving more and more into the centralized Reserve Bank of New Zealand with debt to income ratios. So this will affect availability of credit in a way, but not necessarily right away. So what are your general views on DTIs, or debt to income ratios?
I think my general views are that this is an increasingly used tool globally for what they call macro-prudential or sort of financial stability type purposes. Reserve Bank of New Zealand developed the loan-to-value ratio tool a good few years ago, I suppose, and has been working on trying to develop the debt-to-income tool. It's actually taken a while because it requires a lot more information than an LVR. Basically, you have to have all of the information that banks collect on a customer's income, so that you can kind of like work out what a reasonable debt to income ratio is. I think that right now those settings have been calibrated at a point where they're not really going to be that important, I think, for most people. That probably won't be the case when we go into the next cyclical upswing in the housing market, because what will probably happen is that house prices will rise relative to incomes, and at some point those DTI restrictions will start to become binding, and banks will end up having to ration credit to those borrowers with the higher debt to income ratios. But as it happens, that's exactly what the Reserve Bank wants to achieve, right? They want to actually slow the supply of credit to those parts of the customer base which are riskier.
It really is about financial stability, and that's kind of what they've made abundantly clear. But it's kind of like the financial stability with the loan to valuation restrictions was more about the financial stability of the banking system, perhaps, whereas now it's like the financial system of households and the economy. Or that's kind of my take on it. Would you agree with that? Yeah.
I think a lot of economists might say that you don't need both of these tools. You can have one or the other. But I guess the DTI tool is a lot more granular in the sense that it is directly targeting the end borrower's capacity to pay, perhaps better than, for example, their general accumulated wealth or their ability to kind of like access collateral. I
Mhm.
personally think that the DTI tool may be quite difficult to calibrate in practice. If you look around the country, you'll see that house prices are at quite different levels. If you're in Auckland versus Oamaru or Timaru or Dunedin or Christchurch, incomes are different as well, but I don't think they're as different. So you may find that in parts of the country, the DTI tool becomes more constraining quicker. Say in places like Auckland, where housing is generally more expensive compared to other parts of the country.
Yeah. Yeah, it's gonna be really interesting, like some of the distortions, right? Because if you were a property investor earning money in the big city in Auckland here, but you were buying an investment property in Dunedin or Gore, then that might level out house prices a little bit nationally. Kind of like, I guess, with LVR restrictions in the early days, and even just the distortions created by exempting new builds from interest deductibility rules. Every time we implement all these new rules, it creates all these distortions and feedback loops and messiness. Do you see that this might be a little bit problematic in the future?
I think it could be, yeah. Like, I mean, the more deeply calibrated these tools get, the more customized they get, I think the greater the possibility of unintended consequences in terms of perhaps, drawing a line in terms of the availability of credit, perhaps arbitrarily between different groups of borrowers. It certainly does seem plausible to me that if you're an Auckland-based investor, you may find it much more attractive to, for example, borrow for an investment property outside of Auckland.
That's right. Yeah.
Get a place down in Oamaru. Or I'm from Oamaru. When I was a boy, like my sister contacted me actually recently. She's got a rental property down there, and she showed me the numbers, and I could see, man, that's actually quite compelling compared
Yeah.
to trying to do the same thing in Auckland.
Interesting, isn't it? So it kind of is like a picture of, well, what could be a really interesting long-term strategic play if you were a property investor. And again, it creates distortions, because what about the local first home buyers in those areas? Now they're competing a lot more with the big city folks
Mm.
coming up and buying up the neighborhoods. And I guess what happens is whenever there's more regulation, it seems to concentrate wealth into fewer hands. But okay, I'll pivot onto another question. Last one on this one. What do you think about the increasing trend, though, around this centralization of credit decisions, if you like? That's kind of what's happening in slow motion, isn't it? Where the Reserve Bank of New Zealand is starting to make a lot of the decisions that used to be made at the grassroots level with retail banks.
I mean, it's a global trend that's been in place since the global financial crisis, where everything went so badly wrong because there are relatively few of these sorts of rules in place. And people relied heavily on the interest rate being the constraining factor to stop excessive risk accumulating.
Mm,
And it became apparent that that's not necessarily any guarantee that that will be the case at all.
mm,
Um, so the trend there has been towards less kind of like interest or price based tools and more quantity based tools to try to better manage those risks. I think that's
mm,
probably a reasonable direction to go, at least to some extent, but it doesn't come without issues. For
mm.
example, well, you mentioned yourself the issues they had with the LVRs, Auckland versus the rest of the country. Like the more of these sorts of rules you put in place, the greater the chance that you end up with arbitrary lines being drawn, which you
Yeah.
may not necessarily like or intend or even be able to explain or justify.
And so, as we come into the landing for this conversation today, I just want to finish up on something that is happening more in the geopolitical space. The risk of war expanding. We have the Red Sea, Panama Canal due to water shortages. There's like traffic's down up to 90%, having to go around South Africa now just to get stuff to Europe. And ultimately, this filters through like to food and energy prices. So, am I reading that correct for a start? And do you see that as a significant risk of unexpected higher inflation that might persist for longer?
Yeah, I think it's certainly a real challenge. Container shipping and insurance costs have gone up by about 30%, I think, since sort of November last year, and that's just with the combination of that Panama Canal kind of blockage, as well as the trouble in the Red Sea. So that's going to be a notably different environment for importers in New Zealand when we get through to the middle of this year compared to the last year, where those prices were actually falling off quite significantly. So I
Mm,
do anticipate that we'll see some inflation and some of those sorts of things. Where it will get a lot more significant, though, is that if it flows through to oil prices. So
mm,
if oil prices end up having to rise really significantly because there's a broader kind of like military escalation in the Middle East, well,
yeah.
then you can absolutely see what that will do to the CPI. Um,
Mm,
the one thing I would say though is that even though this is a noticeable shift in environment compared to last year, it shouldn't be overstated. We're probably looking at something that's much less worse than we saw during COVID, because
mm,
COVID had the same kind of impact, actually a much greater impact on container shipping costs, but it also influenced all the way through the supply chain.
mm,
Ports couldn't operate properly, factories couldn't get workers to make stuff. None of those
mm,
things are happening now. So whilst I do expect that there will be some impact on tradables inflation, I don't expect it to be as large as what we saw at the height of COVID. I guess the other geopolitical thing I've got on the agenda this year is the US presidential election. It seems reasonably likely that Donald Trump will be the contender, and the opinion polls seem to suggest he will win the election. America in general, I think, has become more antagonistic towards China, which are our biggest trading partner. And
yeah.
there is the potential for a much more hawkish approach of the West towards China as we go through this year and into the next few years. And I think that
Mm,
could certainly have implications for trade flows and New
mm.
Zealand as well.
That puts us in a really awkward position, right? Where we have to choose between our security partner potentially and our trading partner. Is that kind of what you're alluding to?
Yeah, that's right.
Okay. And like just to finish up on, what are some of the other things? Like, what are we missing here? Is what I'm wondering. If war expands, like I'm thinking, just in the last few days, there seems to be a lot more tit for tat with Iran, the U.S. We have China, Taiwan. The Middle East is just a disaster, and then obviously we got the Russian-Ukrainian thing. So, what do you think? Like, are there other things that should be on our radar that aren't on our radar in terms of how it will affect the everyday investor in New Zealand here if war does expand?
Well, I think one of the implications of an expansion of those sorts of trends would be in a much increased risk environment compared to the last few years. I mean, one of the things that you can sort of see in the prices of risk, if you look at for example, the equity volatility indices, they're all really low right now, right?
Mm,
They're basically saying that the markets are not really pricing very much risk. And obviously that could change quite significantly, and that would normally have a depressing impact on asset prices for that reason. The implications of things like a Taiwan blockade and stuff like that, I mean, I sort of take as a model what happened with the outbreak of the Russian war in Ukraine,
yeah.
where the international community moved really quickly um, to sanction Russia, and essentially made it really difficult for a lot of European countries in particular to do a lot of imports and exports with Russia, which was an important part of their trading relationship.
Mm,
Um, I do worry that we may have the same issues here as well, given that we've got a really large trade relationship with China. Um,
mm, hmm.
and whilst things like we do a lot of food exports, which typically are not sanctioned, but financial sanctions are really encompassing. So you may be able to sell your milk, but you may not be able to get paid for it.
Slight detail, right? So,
Yeah.
okay. So those are the two kind of things that you would be pointing at if war was to escalate. Number one would be the U.S.-China relationship,
Mm,
and then number two would be the fact that volatility is at a record low, and if volatility spikes, then that increases I guess that increases the return that investors demand when they make
yeah.
investments. Therefore, if interest rates go higher as a result of that risk premium, then that brings the asset prices themselves down. We've been looking at inflation a lot around how that is a driver of interest rates, but don't forget that risk premium. Is that kind of true?
That's right. Yeah, the risk premium is critical in those situations, and it's been one where the risk premium has generally been relatively low now for a few years, and I think that
Mhm.
is has been one of the drivers of asset prices
Mm,
in the last few years.
interesting. Stability is risky sometimes. Okay.
Well, we had this great moderation, the geopolitical kind of like dividend, like the that we all benefited from for 30 or 40 years.
Yeah.
And if that's not going to be there anymore, then there's going to be implications.
And I guess that's why there's this question which started probably midway through last year for me, which is the question of, will we have higher interest rates for longer, or will it be lower and sooner, business as usual? Because we seem to have this changing of the world order, this macro massive secular trend shifting that started in the early 80s of gradual falling interest rates. If that reverses, then there's possibly going to be a lot of adjustments to house prices. Would you agree with that?
Yeah, yeah. I mean, one of the real things that's helped drive house prices up for the last 30 years has been the significant downtrend in interest rates, right? So,
Yeah.
and some of these things we're talking about might arrest that downtrend, maybe even make them go up a bit. It wasn't that long ago that a 5.5% OCR would be kind of just middling, really, for the Reserve Bank. We all got quite used to 2% OCRs or 1% OCRs for some people. And as a result, asset prices got bid up because of that. But that may not necessarily be how things pan out for the next 5 or 10 years.
Either that, or there's a swap in the drivers between what influences interest rates. Like you said before, maybe it's more of a risk premium rather than as a as an adjustment from the Reserve Bank to influence inflation.
Mm.
As a result of that, they become less potent. Do you see that as a possibility, that because of falling house prices, they need to maintain financial stability? They kind of fade into irrelevance because now it's really just an international game.
Yeah, so I mean, I don't know if falling house prices are necessarily associated with financial instability. I think it depends a little bit on how fast it occurs. I mean, a lot of the stress tests that the Reserve Bank does on banks usually come out with the result that banks are very resilient to
Mm,
falls in house prices because
mm,
we do have LVR rules and we have, we do due diligence on customers and things like that. There's a lot of resiliency, I think, built into the system,
mm,
particularly if what you're seeing here is maybe a long period of relatively flat house prices so that they fall in real terms
mhm,
over a period of time. I
mm.
guess things are a bit different if something calamitous happens and house prices suddenly fall in nominal terms by 30 or 40%. But that's not necessarily the sort of scenario you're talking about here.
No. Yeah, and I guess, like, there's 2 parts to this, right? Like, a financial collapse could be a collapse of the system or everybody who's plugged into the system, like everyday people, right? And as
Yeah.
long as the system is functioning well, I think that's probably ultimately what's gonna be prioritized, right?
Mm. Yeah, I mean, one of the things about the system that works relatively well in New Zealand compared to a lot of the other countries I worked in the last 11 years is that we have very good supply of capital.
Yeah.
Like we borrow. We've been running a current account deficit for probably as long as I've been alive, and
Yeah.
it's financed by the fact that foreigners have been very willing to lend to us. I guess in the sort of environment you're talking about, there could be an increase in risk premium, and as a result, it might be more expensive or difficult to get money. Perhaps the exchange rate might need to be a bit lower as well.
Mm. Okay. There's so much more we could probably go into there, as you can tell, but we've spoken for long enough. You've been really generous with your time. Really appreciate that, Kelly. And if people want to follow a little bit more, like I just follow you guys, everybody there from from the Economist team at Westpac. I follow you guys all on LinkedIn, but if people want to kind of get a bit more connected to what you guys are putting out there in terms of research and publications, what could they do to subscribe to something or visit something? What would you say?
So anyone can subscribe to all of our regular research. If you go to the Westpac Economics website, for example, there'll be a link there where you could just sign up and you'll get an email basically with all the stuff we put out.
Fantastic. All right. Thank you very much, Kelly Eckhold, Chief Economist at Westpac. Thanks for the chat today.
Good as gold. Nice to talk to you.
Likewise.